Hello and welcome to our video on the 7 Golden Rules of Investing. Investing can be a great way to build wealth and achieve your long-term financial goals, but it can also be challenging and risky. That's why it's important to follow some basic rules to help guide your investment decisions. In this video, we'll be discussing the 7 Golden Rules of Investing, including why they're important and how you can apply them to your own investment strategy. Start early. Starting early is one of the most important things you can do as an investor. The earlier you start investing, the more time your money has to grow. This is because of the power of compounding, which allows your money to earn interest on top of interest. Over time, this can make a huge difference in your investment returns. For example, let's say you start investing $1,000 a year at age 25 and continue to do so until age 65. Assuming an average annual return of 7%, you would end up with around $366,000. But if you wait until age 35 to start investing, you would end up with only around $189,000. That's a huge difference. Diversify your portfolio. Diversification is all about spreading your investments across different asset classes, such as stocks, bonds, and real estate. The idea is that if one asset class performs poorly, you have other investments that can help offset the losses. By diversifying your portfolio, you can reduce your overall risk while still achieving solid returns. For example, let's say you invest all your money in a single stock. If that stock performs poorly, you could lose a significant portion of your investment. But if you diversify your portfolio across multiple stocks, bonds, and other asset classes, you can reduce your risk and potentially earn better returns. Invest for the long term. Investing for the long term means avoiding the temptation to try to time the market. Instead, focus on investing in solid companies or funds that you believe will perform well over the long term. This allows you to benefit from the power of compounding, which can significantly boost your returns over time. For example, let's say you invest in a mutual fund that returns an average of 8% per year. If you invest $10,000 and leave it alone for 30 years, it will grow to around $100,000. But if you try to time the market and sell your shares during a downturn, you could miss out on significant gains over the long term. Keep your emotions in check. Investing can be emotional, but it's important to keep your emotions in check. Avoid making knee-jerk reactions to market movements and instead stick to a well-thought-out investment plan. This will help you avoid making costly mistakes and stay on track to achieve your long-term investment goals. For example, let's say the stock market takes a big dip and your portfolio loses value. It's easy to panic and sell all your shares, but this is usually a mistake. By selling during a downturn, you're essentially locking in your losses and missing out on potential gains when the market eventually recovers. Minimize fees and expenses. Fees and expenses can eat into your investment returns, so it's important to be mindful of them. This means choosing investment products with low fees and avoiding unnecessary expenses like trading fees and account maintenance fees. Over time, even small fees can add up and significantly impact your returns. For example, let's say you invest $10,000 in a mutual fund with a 1% annual fee. Over 30 years, that fee would add up to around $10,000 in lost returns. By choosing a lower fee investment product, you could potentially save thousands of dollars over the long term. Stay informed. Staying informed about the financial markets is important for making smart investment decisions. This means keeping up to date with news and trends in the stock market, bond market, real estate market, and other investment areas. It also means staying informed about the companies or funds you're investing in, including their financial health, management team, and growth potential. For example, let's say you invest in a company without doing any research first. If that company performs poorly, you could lose a significant portion of your investment. But if you stay informed and do your due diligence, you can make better informed investment decisions that are more likely to pay off over the long term. Maintain a balanced approach. Finally, it's important to maintain a balanced approach to investing. This means not putting all your eggs in one basket and instead focusing on diversification, long-term investing, and other sound investment principles. It also means balancing your investment portfolio with other financial goals, such as saving, budgeting, and managing debt. For example, let's say you put all your money into stocks and ignore your other financial goals, such as paying off debt or saving for emergencies. This can leave you vulnerable to unexpected expenses or market downturns. By maintaining a balanced approach, you can better manage your overall financial picture and achieve greater financial stability over the long term. Thanks for watching, and as always, please remember that this video is for informational purposes only and should not be taken as financial advice. As always, it's important to do your own research and consult with a licensed financial professional before making any investment decisions.